Hey everyone, welcome back to Corporate Decoder. Today, Rowe Price Index Trust Inc. just filed their second quarter report, and I'm seeing a few interesting trends in their holdings. Quick note, this is not financial advice, just my take on public filings for educational purposes. This fund is all about tracking the entire US stock market, so we are going to dig into what that actually looks like right now. So this is the semi-annual shareholder report for the Total Equity Market Index Fund. Basically, this fund tries to own a little bit of every publicly traded US company to mirror the whole market. Think of it like owning a tiny slice of the entire American economy. Let's start with how they are spread out across different parts of the economy. The biggest chunk by far is in information technology, coming in at almost 36%. This shows how much of our economy is currently driven by tech companies. Following that, we have financials at 12.2% and industrials and business services at 10.5%. Healthcare is also a significant slice at 9.4%. On the flip side, real estate is a smaller part at 2.2% and energy is at 3.1%. Now let's talk about the absolute giants in this fund. The top holding is NVIDIA, making up 6.6% of the fund's assets. That is a huge chunk and really highlights NVIDIA's current dominance. Apple follows closely at 5.8%, and Alphabet, which is Google's parent company, is at 5.2%. Microsoft is at 3.8% and Amazon.com is at 3.2%. Broadcom is next at 2.5%, followed by Micron Technology at 1.8%, Meta Platforms at 1.7%, Tesla at 1.6%, and Advanced Micro Devices rounding out the top 10 at 1.4%. What is striking here is the heavy concentration in just a few massive tech companies. If these few companies stumble, the entire fund will feel it significantly. Looking at some key numbers for the fund, we see total net assets are a massive $3.358 billion. That is a lot of money tracking the market. The fund holds 1144 different investments, which sounds like a lot, but when you consider it's tracking the entire market, it is actually pretty focused. The portfolio turnover rate is only 1.3%. This means they are not buying and selling stocks very often, which makes sense for an index fund. They are mostly just holding on to these assets to match the market index. Now let's dive into the financial performance. Looking at the financial highlights for the 6 months ended the 30th of June 2026, the net asset value per share was $79.1 at the end of the period. This is up from $71.13 at the beginning of the period. The total return for this 6-month period was 11.20%. That is a solid return and aligns with how the broader market likely performed. For context, the year ended the 31st of December. 2025 saw a total return of 17.10%. The gross expenses before any waivers are just 0.18% and the net expenses are also 0.18%. This is incredibly low and is a huge benefit for investors in an index fund like this. Flipping through the portfolio of investments gives you a real sense of the breadth of the market. You see companies like AT&T in communication services, General Motors and Tesla in automobiles, and of course the big tech players like Alphabet and Meta Platforms in interactive media and services. In the consumer staples section, you see Coca-Cola and PepsiCo representing everyday necessities. The energy sector includes giants like ExxonMobil and Chevron. The financials section is vast with major banks like JP Morgan Chase and Bank of America. In healthcare, you have companies like Abbott Laboratories and Johnson & Johnson. Industrials are represented by names like Boeing and General Electric Information Technology. As we noted, is heavily weighted with companies like NVIDIA, Apple, Microsoft, and a whole host of semiconductor companies. Materials includes Dow and DuPont. Real estate shows companies like Prologis and Simon Property Group. And finally, utilities includes companies like Nextra Energy and Southern Company. This massive list of holdings is what makes up the US stock market as a whole, and this fund holds it all. Looking at the statement of assets and liabilities, we see the total net assets are indeed $3.358 billion, as we saw earlier. The cost of investments was $848 million, but their current value is over $3.3 billion. This massive increase in value reflects the growth of the stock market over time. There are some short-term investments and securities lending collateral, which is a common practice for large funds to generate a little extra income. The statement of operations for the 6 months ended the 30th of June 2026 shows total investment income of about $18 million. Expenses were quite low at just under $2.8 million. The net investment income was over $15 million. The real story here is the net realized and unrealized gain, which was a staggering $322 million. This massive gain is what drove the increase in net assets from operations. The statement of changes in net assets shows an increase of over $337 million from operations during this 6-month period. This is a substantial gain. There were some capital share transactions, meaning shares were bought and sold, but the net effect was a decrease in net assets from those transactions. Overall, though, the fund grew significantly during this period. One of the key benefits of an index fund is its low cost. The investment management agreement here has an annual fee of just 0.09% of the fund's average daily net assets. They also have a contractual expense limitation of 0.30%. This means that even if other operating expenses were to rise, the total expenses for the fund will not exceed that 0.30%. This is incredibly investor friendly and a major reason why index funds are so popular. This fund is actively managed to track an index, which means the management fees are extremely low compared to actively managed funds. Now, let's talk about the bigger picture. This filing really shows how much the US stock market is dominated by a handful of massive technology companies. The heavy concentration in information technology and the top 10 holdings like NVIDIA, Apple, and Microsoft means that the performance of this fund is extremely tied to the fortunes of these few giants. While this has been a winning strategy recently, it also presents a significant risk. If these tech titans falter, the entire market, and therefore this fund, will take a hit. The low expense ratio is a huge positive and something all investors should look for, but the real story is the increasing concentration in mega cap tech, which is a trend to watch very closely. The fund's direction is essentially dictated by the market itself, and right now the market is heavily leaning on tech. That is my take. Stay decoded. The research tools I actually use are linked in the description. They help keep this channel going.